Hi everyone, and welcome to today's Volatility Returns Lessons from 2022 for today's crypto market live stream. Thanks everyone for joining us. I'm joined today by Fabian Dorey, Signum's Chief Investment Officer. Hi Fabian from Singapore. Okay. Can you hear us, Fabian? Okay. We'll continue on for the moment. We get the tech issues solved, and also joined by my colleague Thomas Fry, Head of Strategic Product Initiatives, here to share their take on the market volatility and lessons from 2022. So as always, all content and opinions presented on this live stream do not constitute investment advice. So let's get going. So Bitcoin fell below $70,000 as crypto fell off deepen ahead of the US equities market open. The above move marks Bitcoin's first drop below its 2021 highs since November 2024. Selling pressure remained concentrated in crypto and precious metals, with sentiment slipping into extreme fear territory, with the US equities trading higher in pre-market. So to give us some insight, let's get going. While Fabian comes back online, we might go across to you, Thomas, or you ready to go, Fabian?
Yes, apologies for the technical difficulties.
Perfect. We're ready to go then. So so the first one comes across to you, Fabian. Bitcoin's down 40% from its October highs. So what's, in your view, driving the current drawdown?
Let me first start with a bit of a general answer and then come to the more specific drivers in a second. In general, Signum has been following the asset class, the crypto asset ecosystem, for basically a decade. And markets like we experience these days are a reminder of the impression that it sometimes feels a bit like accompanying a newborn as it grows from a toddler to a child, then a teenager, and beyond, up to the age of adolescence, where certain complications begin. Now, along this journey, you gather a lot of heartful memories that last forever, but also come across difficult situations that are very painful in that moment, and you can only laugh about months or even years later. I do believe that the current price action might be exactly such a moment. But it's a painful one, and I guess the reasons being manifold. There's not a single driver for the market correction, but rather it's a collection of several things compounding. First, there are still concerns around the historical 4-year cycle repeating, which leads to certain supply from long-term holders coming into the market, which brings it in general on a thinner ice to walk on. Second, quantum risk concerns, whether justified or not, are negatively weighting on the store of value use case for the most established protocol, namely for Bitcoin. Third, and maybe more from a macro perspective, liquidity conditions have significantly, and to a certain extent also surprisingly, tightened in Q4 last year against the backdrop of the US Treasury building up a considerable cash reserve and soaking short-term liquidity out of the market. This was then very specifically for crypto further exacerbated in the crypto space by the October 10th event with a historical liquidation cascade, which likely reduced the willingness and the risk appetite of market makers to provide liquidity, which further amplified drawdowns and volatility over time. Then also on the regulatory side, we see a certain stallment with regards to the Clarity Act, which is a key regulatory piece needed to bring clarity to the broader crypto ecosystem. Now this is delayed because of discussions about the question whether stablecoins can and should provide yield. And then also, I think, adding to the overall uncertainty was this, to a certain degree, surprising revelation of Warsh as the next Fed chair nominee. I think he's probably more difficult to read than other candidates when it comes to a hawkish or a dovish Fed policy going forward, while he's still clearly pro-crypto and pro-Bitcoin. I think this is the mosaic of elements that contributed to the current market volatility.
Yeah. So some growing pains. So, but I mean, the current volatility, do you think it resembles the patterns we saw in 2022? Yeah, and are the dynamics today, the fundamentals, fundamentally different, or if so, where would they be?
Yeah, I see both. I see similarities and differences, maybe more differences than similarities. So let me start with the similarities first. Clearly, it's a very significant risk-off sentiment, right, for the full ecosystem. Virtually all tokens are down, maybe with a few single exceptions, which evidences a clear flight to trust, to stability, and a bit again, as in 2022, I think the volatility is a clear stress test, bringing back the question, the very fundamental question about the right to play for Bitcoin.
Mm.
However, there are really significant differences to 2022. First, relating to the macro environment itself. 2022 was marked by that significant liquidity injection following the COVID crisis, which led inflation to overshoot. Central banks reacted slowly, but ultimately very considerably, rising rates in 2022 quite significantly. 2026, on the other hand, inflation is still sticky above the 2% target, but at the same time, the true inflation indicator has significantly collapsed, and we're very likely still in a rate cut cycle, at least in the US, which gives a totally different macro backdrop to the current environment. Maybe then more specifically regarding crypto, 2022 has been marked by very crypto-specific structural failures, experiments around innovations such as algorithmic stablecoins, but also others. Then the default of centralized key players such as Celsius and FTX, which really caused a systematic risk to the ecosystem that led some to call the FTX event the Lehman event for crypto. Now in 2026, I do not see such an imminent risk on the systematic side. Maybe apart from the potential risk related to quantum computing, which is quite controversially discussed in the ecosystem right now. But apart from that, there's really not such an imminent systematic structural risk factor in the market right now. I think what also is quite different is and related to that, right, the quality of counterparties, which is still very, very important. And unlike 2022, there are now various fully regulated financial institutions, banks that provide trusted, audited custody and trading services, enabling exactly assets that are flying to safety, security to be custodized in a proper way. There's also, I would say, a difference in fundamentals. 2022 was marked by deteriorating fundamentals. In 2025, 2026, fundamentals also on the on-chain side have significantly improved. So clearly bringing in a gap between sentiment and fundamentals. And also, not the least, the regulatory angle has clearly changed a lot. 2022, a lot of the ecosystem was not regulated yet. This is quite different right now. We have the Genius Act, which was implemented last year. Even though it's stalled, the Clarity Act is in the making, bringing clarity to the broader ecosystem. So there are quite a lot of differences from a structural point of view. But also from an investor point of view, I think today there is a much broader set of instruments, strategies that are available to manage the risk-return profile in different market conditions in various ways. Be that through fully market-neutral strategies, which help diversify and providing a yield in a fully market-neutral way. Be that through risk-controlled strategies, which actively manage the exposure depending on market conditions. So scale up the exposure when conditions are positive and scale down when volatility and drawdowns increase. But also very actively managed strategies that try to exploit markets in all market conditions and to try to generate alpha over time. So also from a very investor point of view, markets are quite different than in 2022.
Yeah. And Thomas, I might bring you in here. I mean, given these similarities and differences, what do you think the lessons that the crypto industry has kind of learned since 22 on your side?
Yes. Just circling back to a few of the systematic risks that Fabian has mentioned, right? In 2022, several traders have seen governance and control failures by exchanges, have seen security risks being exploited, withdrawals halted. Several of them have found their assets wound up in bankruptcy proceedings for years to come, or they might never even see their assets anymore. I think traders have definitely learned from that, especially that counterparty risk matters. And today, there are luckily solutions out there that can help.
But on days like today, when the volatility is high and counterparty risk suddenly matters more, I mean, how can traders reduce the platform risks without stepping away from the market opportunities altogether?
Yeah, by now there are a number of off-exchange custody solutions available. One of them is called Signum Protect, which is provided by Signum. What these solutions do is that they separate custodial with exchange responsibilities, like we have it in traditional finance. In crypto, where you need to have your assets on the exchange to trade, you're typically exposed to these counterparty risks that we've mentioned. With these off-exchange custody solutions, you can have your assets with a regulated custodian, such as a Swiss bank, and still trade on these exchanges. We enable this through contractual frameworks, which we have in place with several of these. And basically, the exchanges recognize the assets in custody with Signum, for example, and provide a loan against these assets, a virtual margin, or just mirror them one-to-one. So that's how you can still trade on exchanges, trade the volatility, and still have the safety of a regulated custodian.
I mean, Fabian, going back to you just on the crypto fear and greed index is at extreme lows. Do you think in the short term this is going to improve?
The interesting part of such sentiment indicators is that when they are in extreme territory, they often act as a contrarian indicator. And right now, as you outlined, we are clearly in a very extreme fear scenario. From a historical point of view, that should revert. And I believe there are indicators that clearly speak for that. On the fundamental side, which clearly remain very strong, I relate again to the regulation that is further advancing, but also the institutional adoption that is significantly advancing and may provide a certain floor on the drawdown side. But then also the on-chain activity, which is still growing, very much driven by stablecoin adoption, tokenization, and also tokenization of stocks and other financial assets, which is clearly progressing. And then also staking frameworks that are much clearer, bringing assets on-chain. I think what also speaks for an improvement is the fact that many protocols are reviewing their tokenomic models and redesigning them in a way, or trying to redesign them in a way which brings true value accrual to the token holders. For example, by generating real revenue, which is then brought to the token holders in form of token burns, instead of just pure inflation, which is currently seen quite negatively. What is also an interesting indicator to follow are exchange reserves, which are at all-time highs right now, is an evidence for a declining marginal supply. But these are more the midterm fundamental factors. I think there's still significant short-term headwinds that one needs to be aware of. Sentiment is low, so there's not a lot of negative news needed to spike another volatility event or further drawdowns. And I think the geopolitical situation remains quite tense, which could result into a certain escalation. And again, on a broader level, the 4-year cycle is still in the head of many and leading to a certain supply that is coming to the market. So I would say midterm, very strong fundamentals, but in the short term, there are significant headwinds one needs to be aware of.
Yeah. we're talking about headwinds. Back to you, Thomas. I mean, what do you think determines whether an off-exchange structure can actually reduce risk rather than just shifting it from that perspective?
I believe there are two answers to this. The first one is the legal structure that ensures that the assets are indeed bankruptcy remote and protected. In Switzerland, for example, the Swiss Banking Act enables Signum to hold traditional securities in crypto off balance sheet, bankruptcy remote. So this means even in the unlikely event of a default of Signum, the liquidator would transfer these assets of clients to another custodian as instructed by the client. So this already provides one strong security feature, which definitely helps in this market. The second one is the stability or basically availability of collateral. Fabian has mentioned a few asset types that help in this environment. Because unlike a pure crypto player, Signum, for example, can also hold fiat, traditional securities such as government bonds, which are typically very stable, also in this environment, highly liquid, and can help to diversify.
Okay. But Fabian, just to leave the last one with you, I guess, is the favorite old question, outlook. What's your current outlook, and what do you think some catalysts that could shift market sentiment in a positive direction from here?
Maybe relating to the sentiment before, I think in the short term, market exhaustion might be near, right? If you look at indicators that historically were close to such an exhaustion, we see that, again, sentiment is very much beaten. We see funding rates significantly negative, which is showcasing that many investors are running for hedges by adding on that exposure. But also technical indicators such as relative strength indices and so on, they clearly indicate that from a historical perspective, we might be near to at least a local low. But again, timing is very uncertain, especially in the short term. So I think always need to be aware that markets can stay or remain irrational longer than expected. But I see catalysts that might bring about a change in the market direction. There are, on the one hand side, so to say, binary catalysts which might emerge, such as the approval of the Clarity Act, which would really be an extremely positive development in bringing regulatory clarity to a broader part of the ecosystem. This could also be a surprising de-escalation on the geopolitical side. So these binary events are possible. And then there are the steady ones, right? There are clear indicators that the business cycle is about to improve. I would say the very constructive liquidity backdrop is starting to play out. We have seen the NFT in December last year. Now the rate cycle is likely to continue. There is a change in the capital reserves for major US banks, which will allow them to unlock additional private credit creation, also positive. And again, there's a lot of effort put into addressing the quantum risk. So progress on that side, bringing Bitcoin and other protocols into a quantum resistant level that will also help over time. Having said that, again, there are risks to keep in mind. Geopolitical tensions, certain degree of macro uncertainty, for example, relating to the Japanese bond market, but also what we have seen over the last 2-3 days, the concerns that the significant artificial intelligence capital expenditure that was executed might not yield into sufficient profitability, or if there would be a sudden advancement on the quantum development, that would also be a risk to be kept in mind. So overall, I think it's worthwhile to really maintain a cautious positioning, right? But at the same time, be aware of the strengthening fundamentals, which are not deteriorating, and making sure that you can navigate through that environment in a risk-controlled manner.
Okay. I think that's about all we've got time for today. Thank you, Fabian. Thank you, Thomas, for jumping on this live stream to share our views with the audience. Here at Signum,
the Monad has raised multiple rounds, and then most notably recently, you guys did one, if not the first, ICO on Coinbase, and where you raised about $269 million from more than 80,000 individuals, or even more than 85,000 individuals. I don't remember what the exact numbers are, but like really impressive ICO. Now that mainnet is live, what metrics are you looking at, and what's your strategy to keep growing the network?
Yeah, appreciate the question. I think that's a really good one. I think that we've had a very successful token sale, as you mentioned, and post mainnet, it's really easy to get lost in vanity metrics that don't actually signal real adoption and traction. What we focus on within Mana Foundation is, one, how do we maximize Mana's GDP? Ultimately, is it that total economic value generated from on-chain is the ultimate measure, right? I think, and so the question that we ask is, how do we facilitate real economic activity, real trading volume, and real settlement value on Monad? And it's the other thing that is really important to us is having successful startups being built on Monad, having businesses with real revenue, real users, real traction, and a product market fit that oftentimes is sort of understated here. The other part that feeds into that is, a lot of developer interest and interconnected founder community, where we see an ecosystem, with there's a lot of best teams collaborating and accelerating innovation to compounding value that unlocks a lot of the possibilities for an EVM chain to help unlock some of the aspirational use cases that have been discussed over the past decade. These are signals, I think, of genuine utility and adoption. They really truly measure whether or not a blockchain is becoming essential infrastructure, and whether or not these are real adoption and traction within some of these businesses on chain. And so that is the only metric that ultimately matter to us.
Yeah, and finally, Eric, you guys also have a lot of vanity metrics to to talk about, but most notably, you raised $135 million from all the top names in finance, including Goldman Sachs, DTCC. I think there was also BNP and Paxos and a number of other big names. And so and you completed the first on-chain treasury financing in August. In January, JP Morgan announced that JPM Coin is coming to Canton as well. What do you see there? What's driving this institutional momentum? You said, it's always been there, but people it's been underreported. What's driving this institutional momentum, and what are you guys looking forward to?
Yeah, I'd say the fundraising round is probably the least interesting thing that's happened in the past 9 months. The network adoption is pretty incredible over that same time period. I would say that we have a long track record of demonstrating material utility to adopters of Canton for their use cases, and that utility is growing. So the first use cases that went live, and then their customers, and that sort of very clear utility to all of those participants is generating some form of a Lindy effect to an extent. Like some of the use cases that we've had have been in production in excess of 4 or 5 years, and they're managing trillions of dollars of volume on a regular basis. And that sort of undeniable utility is something that brings a lot of confidence to continue to grow and drive more activity. There's also, of course, the number one, if not only, benefit of blockchain to users is composability. So as that ecosystem grows, the value of that is growing more than linearly for them. So I used to be able to hold a bond, but now I can pledge a bond into a repo. I used to be able to do a repo for Fedwire, but now I can do repo for stablecoins, or as you mentioned, JP Morgan coins. So like the utility is accelerating and compounding for them thanks to composability. So that sort of whole ecosystem of value is picking up steam, and they are their peers. So they are exactly the entities that they want to interact with. Those are exactly the entities and their counterparties that they have that exist, well, the frictions that they have today. So resolving that solves material problems today. So for us, our entire focus is on the immediate executability, addressability, and utility of what someone would be doing on chain, and driving those large participants. I mean, the names you mentioned are in hundreds of markets, right? They're not doing hundreds of use cases with us yet. It's still early, but we're directing them into the things that have that immediate benefit to them and their clients, and focusing on stuff that doesn't try to reinvent the wheel. So a good example is that, people use cash as part of every single transaction that they do in the world today. The ability to do that 24/7 with the same balance sheet and counterparty risk that you have today is additive. That allows you to do stuff off hours on the weekend that you can't do today. That allows you to solve problems that you can't solve today. But it's not introducing a whole new way of thinking about an asset class. It's just extending what I do into greater opportunities. Treasuries, same thing. People use treasuries to finance their bank or finance their balance sheet in repo and collateral positions all the time. But again, limited to market hours, Monday 9 to 5, intraday is limited, overnight repo is the standard, IM opportunities are limited, mobility is limited, cross collateral is limited. So increasing the surface area of utility for these assets is what's really driving this momentum on assets that are universally important to them. So not a new asset class that they need to convince the PMs to put a portfolio allocation to, not a new asset classes that might have cost prohibitive balance sheet treatments or risk profile treatments. A treasury with greater utility is something that's just universally high utility to the street. So we're really focused on that sort of stuff. It's not really sexy. It's not really like, groundbreaking in the sense of being transformational of the types of things that you could do, but those optimizations are material and can provide really large benefits, not just to them, but to their customers and further down the value chain.
Mm-hmm. Yeah, and then these are trillions of dollars of volume in applications that we're talking about. And speaking of trillions, so quick round on stablecoins, because they've been one of the biggest examples of strong product market fit in crypto. Stablecoins have moved about 27 trillion in 2024, more than Visa and MasterCard combined. How central is stablecoin infrastructure to your platform's tokenization strategy? How do you interact with them? And how do you see them evolve? And we haven't started yet with Joanita, if you want to give a quick one on this.
Yeah, stablecoins are absolutely foundational to tokenization strategy, or really any strategy, right, on chain. They are the settlement rails, and so it makes everything else possible. Major stablecoins issuers are live on Monad, and we ensure that this with deep liquidity and seamless tokenization from day one. So not treating stablecoins as an afterthought, but really core infrastructure, and having on-off ramps, making sure that there is an efficient infrastructure of highways to transact and to go off platform, off the blockchain. Essentially, stablecoins are how capital enters and exit and move between DeFi, tokenized markets, tokenized assets, etc. So with that, on Monad, we want that movement to be able to move at the speed that institutions require.
Mm-hmm. And who wants to go next? Eric?
Yeah, just as a quick follow-on, we don't overfit on stables. Stables are obviously a very important element of the on-chain economy today, but we think about, just generically speaking, cash on-chain. And the money on-chain ecosystem is a fairly diverse ecosystem, and I think it's going to grow in its heterogeneity before it reduces. We're going to get all sorts of really interesting demand deposit opportunities. There are central bank digital currencies in flight. There are, of course, all the stable coins, but that's a massively growing ecosystem, especially in emerging markets. So all forms of cash on ledger, whether that's regional banks, large commercial banks, global custodial banks, stable coins, central banks, all those different flavors and the coexistence of those against each other, and then also against things like government bonds, again, in each location. They're really important enablers because, I've sat in a few really interesting working groups, and fairly consistently where there are these challenges for a lot of these financial firms is in the interplay between their assets and cash. So, the reason that we're so gung-ho on composability is that we understand that for just about any financial transaction, you have many systems composed together that have to be synchronized together. That generally really clear to participants when they're interacting with the cash side of whatever they do. And so just at a minimum, even if I'm not composing all these different sub-ledgers together, and that can become a little bit more nuanced. But even if I keep our relatively omnibus structured capital markets infrastructure and think about how that plays against the cash leg, then that's where this often comes into focus for a lot of these participants, and they start to see some really early benefits of composability. So cash on chain of many flavors and variants, the ones that'll allow these institutions to participate under their current regulatory regime and under their current behavioral patterns and rules, in combination with stablecoins, all super critical to the success of a broader network.
Kind of can't add more to that if you think about it. Like, all of us don't exist without stablecoins. We need the foundational infrastructure to power our products, power our platforms, whatever we're trying to build. I'd say maybe from my perspective, what we think about is, if Bitcoin is the rails of moving digital money, Stables is the rails of moving cash on chain, exactly as Eric was saying, where we kind of care about the transactional leg of the cash on chain just for settlement, for coupons or things that we've built for on-chain products. More often than not, we're seeing more and more demand for Bitcoin lending for excess stables, right? Everyone just needs access to a dollar equivalent. And our projects that we're working with are actually, some are large institutional, but ironically, we're seeing demand from like small Vietnamese farmers. They have Bitcoin because Vietnam is a large holder of Bitcoin. They can't access dollars, even though they're a dual currency model for the Dong and USD. And getting stable coins across by borrowing against their Bitcoin has been kind of an interesting macro point that we're seeing. And if you think about it, we're essentially rebuilding like the microloans, kind of Kiva style economy on chain with Bitcoin. Everyone in the world can find a means to buy Bitcoin. Like, there is a way. However, getting dollars is difficult. So creating these stablecoin products for on-chain money markets, on-chain treasuries, Bitcoin coupons and such is how like we're seeing a different form of stablecoin adoption that goes beyond the asset tokenization. This is really important to us because at the end of the day, what we're advocating for is either a Bitcoin standard or at least an on-chain standard for every type of asset in crypto, is like what we as Stacks, but more so just anyone who believes in digital assets wants to see.
Yep, and also like in emerging markets and more emerging markets, right? Like, sure, right? Like Bitcoin recently took a 40% drawdown. That's that can't be really used as a currency for the Western world. That's where stablecoins are interesting. But in emerging markets where you can have 20% inflation, or you have crazy and can't access the dollar, that's another thing. And switching back to institutions, typically they want a number of things. They want systems to be performant and scalable. They want security. They want compliance. How do each of your platforms deliver on these? And where do you see trade-offs or points that are more important? And I think, Eric, you'd be great to start with this.
I don't know. I mean, it's complicated. I mean, can you clarify a little bit? Like, what specific sort of trade-offs are you thinking about? Like, I can kind of go in end dimensions here.
I would say, maybe what's the most important to those institutions, right? Is it, from your perspective, is it the compliance part? And if so, like, what's been helpful? Right, like,
yeah,
you've been saying that they operate in 100 different verticals. What's been helpful propagating and adding new verticals?
I think that it all starts with Janita's comment before. Like, it starts with utility, right? So generally speaking, for any of these institutions, what's in it for them and their customers has to become crystal clear first and foremost. So it always starts there. And that's become increasingly clear with the motion around stables and just how cash on chain is really revamping certain industries and certain verticals, and at least presenting the promise and opportunity to do so. So it starts with, okay, I'm convicted that this is a place that we should participate. And then you start to get down into the decision matrix of, well, can we do so responsibly? And responsibly takes many, many dimensions. But generally speaking, the types of things that I consider to be quite reasonable requirements from their perspective is certainty and sovereignty of control over their assets and their behaviors in the network. And I think too often people think about that only in the context of wallet or key management, but that's actually not true. In most networks, you've delegated operation of your smart contracts to a pool of pseudonymous validators, and that doesn't work for a lot of institutions. It's a potentially non-deterministic behavior. It's really economically aligned. You can't guarantee that the outcome of that behavior is what you expect it to be, and that puts them in an uncomfortable situation. So I think that's at least a contributor to what we see on a lot of the decisions around people building their own private chains or building their own L2s or building their own sort of alternative L1s. Is a lot of it starts under this control premise and pool of third-party validators. Another really critical responsibility is when you start to talk about data disclosure. I think it's one thing for an institution to choose to disclose their own data publicly, but it's an entirely different calculus when you start to talk about disclosing your customers' information. So if someone was, participating on a principal basis and trying to optimize their own behaviors, sometimes they're willing to hold their nose and kind of deal with that leakage of information. But the moment you start talking about their custody clients or anything along those lines, and then the conversation takes a completely different tone. So data permissioning, data access, what do people see? What do they have access to? What can they do with that information? That becomes a really, really hot topic. And then I think it's the normal stuff. What's the resilience of this ecosystem? How do I fall back? How do I deal with it? And that, I think everybody has a good answer to that. So I don't know that there's a major differentiation across the ecosystems in that regard. And that I chalk that up to the maturity of a lot of what's taken place over the past decade. But I'd say control, utility number one, and then within that, can I control this and make certain guarantees that I need to make to do this responsibly? And what am I disclosing about my positions, my trading behaviors, whatever that may be, and more importantly, my customers' information to the broader networks.
Yep. And Rena, what are you guys seeing when you talk to institutions?
I think the basic trade-off that everyone is always contemplating is, what are my smart contract risks, what are my custody risks, and what are my counterparty risks that they're going to be exposed for whenever bringing their assets to a network like Stacks or another S or another network. Fundamentally, an institution needs to understand that, is there, beyond transparency, what risks do they have in tech that they themselves did not develop? I think it's a big risk for every institution if they're trusting blockchains that they have no governance, no areas to impact the roadmap or what the technical hurdles are or anything like that. And so everything could be built custom and bespoke, but it also goes against the narrative of wanting to have an open or public blockchain, or have subnets that might be more selective in disclosure or how they're configured. And so it is a catch-22 kind of for most blockchain projects, Stacks included, on who are you serving and what client are we ultimately going to build for? Are we building for an open and fair, equitable economy, kind of the original narrative that Satoshi's mission was? Or are we catering towards, what crypto looked like 16 years ago when we started, and what it looks like now is wildly different, that most of the holders of crypto assets are going to be institutions. And so we as an industry have to level up our compliance or kind of our disclosures and such to fit the norm of what TradFi is expecting from us. I'd say we kind of toe the water kind of on both sides. We are a retail focused chain, but we are a chain that also serves institutions. So it comes with both sides. The best that we can do personally is to make sure that we maintain the adherence of self-custody. I think that's important for any person on this planet, whether institution or not, to have the rails to make sure that you're maintaining your private keys, your secret keys, and every kind of sharded key if you're using a custodian within your own custody, and then create the custom configurations that are needed. Most of our time, ironically, is spent on transaction monitoring and disclosures and making sure that we've created the building blocks that institutions need so that they can do their reporting, which is somewhat frustrating for us.
Yeah, blockchain in general, it's and when you look at DeFi, what's interesting is oftentimes a lot of the reporting tools are not built by the teams that are building the products, so there's a lot of reverse engineering.
And they don't do position management. A trader would book a trade, so you have to reconfigure all of it.
Yeah. Okay, very, very interesting. And Juanita, anything you'd like to add here?
No, I think it's well answered.
Very good, very good. Okay, so let's go through each of your projects, and starting with Rena on the Nakamoto upgrade that delivered Bitcoin finality for Stacks. How do you go about explaining the security model to institutions compared to a WBTC or something else, right?
The best way to think about it is that everything on Stacks, whether it's SBTC or the STX token or USDC issued on Stacks, ultimately goes to Bitcoin finality and Bitcoin security. So we roll up the architecture of the Bitcoin L1. As everyone knows, the Bitcoin L1 has no governance. There is no centralization, but more so, it has had 100% uptime. There's been zero security incidents on the Bitcoin network. And so when kind of building out our project and thinking about how we would make Bitcoin block times go from 10 minutes to something more sustainable for DeFi, sub 10 seconds and such, we wanted to make sure that we maintained the ultimate kind of roll up back to Bitcoin and Bitcoin security. The way you could think about it from like a security perspective is that in the moment for that block transaction that you're doing, you're going to be trusting the stack signer network and our security. However, each block and each transaction ultimately settles back to the Bitcoin L1 as our data availability layer. And so ultimately every transaction will go through Bitcoin finality. So from that perspective, Stacks forks with Bitcoin. So if Bitcoin hard forks after 6 blocks, Stacks must follow suit and vice versa. There's no way for us to architect around Bitcoin blocks and Bitcoin finality. I'd say compared to other kind of derivatives, they're all kind of roughly one and the same, but the key differentiator for if you're going to take your Bitcoin away from the L1 and into an L2, whether it be Stacks or whether it be an EVM chain, is ultimately what are you trying to preserve? For me personally, I'm just trying to preserve proof of work because I fundamentally don't think anything is as secure as proof of work, but other people might have different considerations of they want Solana level liquidity, therefore they're going to bridge to Solana. Ultimately, I do feel like SBTC is the most Bitcoin native, adhering to what the Bitcoin network should provide had it been built a little bit more scalable with its own VM. But at the end of the day, the market will determine what else that they want to use. And ultimately, so long as it comes back on chain, I'm happy.
Yes, that's and that whole interoperability is and like scaling the transactions and being able to go beyond what the base layer for Bitcoin is pretty interesting. And on the Monad side, I mean, you guys deliver more than 10,000 TPS with sub-second finality, and still everything is fully EVM compatible. Unlike other blockchains, they're high TPS. So what tokenized asset use cases does that unlock compared to other EVMs or other non-EVM chains?
Yeah, Monad's performance and low cost unlocks the use cases that are simply just non-viable on slower chains or chains with less predictable fees, right? And so some examples of that is, high frequency trading of tokenized securities, unlocking the ability for, say, an arbitrage strategy where your sub-second finality really matters a lot. The ability for, say, perps market to exist beyond crypto assets, but also into tokenized equities, commodities, fixed incomes. That all matters in terms of that performance. The other thing too is in the cross-asset composability, the ability for people to simultaneously trade, collateralize, and derive from multiple tokenized asset class in a single atomic transaction that is incredibly valuable, and we haven't really seen that yet. This is where I think DeFi promises really can come through on a chain like this, right? And then the last one is, I think there's an opportunity for there to be true efficient market making on chain. Our infrastructure provides tight spreads and where market makers can update quotes and be able to trade 100 times per second without prohibitively high gas costs. And that's, again, very valuable for very high frequency trading, where I think the EVM compatibility has been crucial. A lot of institutions don't want to retrain teams on new languages where it's unnecessary. They want a battle-tested Solidity ecosystem, but with performance that matches that existing infrastructure expectations. It's sort of the best of both worlds, right? If you can solve all of that within EVM, why go somewhere else? And so we've seen that really resonate with a lot of institution plans.
Mm-hmm. Yeah, and Eric, would be interesting if there's anything you want to touch on transaction per second, or the number of transactions and the need for and what institutions are looking, but also but most importantly on Canton and the configurable privacy, which is very rare for public blockchains. And you've mentioned some of the aspects, but why is that non-negotiable for institutions, and how do you balance in all the different transparency requirements?
I mean, on the I'll comment on the privacy element. So it's not that it's rare. I think we're the only, to the best of my knowledge, that does this at all. I'm not aware of anyone that's even trying to solve the problem the same way. And there's a pretty hysterical hit piece from the ETH privacy group the other day that doesn't even really understand the approach that we're taking on Canton, which, God bless them. The thing is that I think it's a bit of a tautology that people agree that privacy is really important. I mean, again, going back to Satoshi in 2009, he talked about how Bitcoin without privacy is just not going to hit exactly the outcomes that they wanted to do, but they didn't know how to do it. And a lot of that framing has been in the context of something like a Bitcoin, where really what a lot of the effort is going into introducing anonymity, which also I think is almost somehow worse than the full transparency. So I have this kind of silly example of, imagine JP Morgan calling their regulator one day going, "Great news, guys. We don't know how much money anyone has in the bank anymore, but don't worry, a black box gives us a green check mark every time something happens." Like, it's just not really what people are looking for here. And so there's this world in between everybody sees everything and nobody sees anything at all, that I think is where 90 some odd % of reality exists, especially when you start talking about real world assets of any kind, whether it's cash or otherwise. And there, the experience that people strictly require is that if you're the issuer or you're some delegated authority on behalf of that issuer, whether you're compliance monitoring or AML or regulatory reporting, that you have full visibility into what's going on at all times, period. Like no uncertainty about that. No asking for a backdoor key, no selective requirement, like full, complete, total transparency for you as the issuer. Like, think about Chase when they operate Chase.com. They know everything about what's going on inside Chase.com. But then if you're a holder or a user or an account participant, you know your world, and you have those same controls and rights and ability to delegate into third parties that information. And if you're not one of those two entities, you shouldn't know anything at all. You shouldn't even be part of validating what's going on there. You're not a party to it. There's nothing that you add to it. So I think that sort of construct is fairly difficult for the CryptoPunks to wrap their head around, because they're so focused on the types of privacy that Satoshi was talking about, and Zuko and team have been building for years, which is around this complete anonymity, which is additive for cryptocurrency, but not for real world assets. Combine that with what I just said is easy to say, hard to do, but even harder to do when you start to talk about not just when it's sitting in your wallet, but when it's in transit, and not just when it's in transit, but using it in composition. So if I put, my silly examples, if I pay for a doctor's appointment with my JP Morgan coin, I don't want JP Morgan to know why I went to the doctor, and I don't want the doctor to know how much money I have. So you also have privacy maintained through composition, and that can become arbitrarily complex too, because sometimes you have these, two compositions, but sometimes you have many, many legs involved. So getting all of those asymmetric views stacked on top of each other correct, and being able to provide all that proof and information and proper disclosure in real time is non-trivial. And I don't think that most entities even frame the problem that way. And again, this is really what the world wants. They just want, because that's a very familiar structure. That's what we have today. They want that plus atomic composability. That's how we solve a lot of these wholesale market problems. That's how we solve international remittance problems, is that we get rid of all the latency of coordinating these systems across each other. But often they're presented with the trade-off of, okay, well, now forfeit control to a pool of third parties, or disclose a whole bunch of information to the world that you really don't want to, in order to get that composability. And if you're not forced to make that trade-off, it makes it much, much easier to adopt, come into the ecosystem, and use it at scale, which is what we offer in the Canton network.
Mm-hmm. And speaking of opening new markets, did you guys announce also the partnership with DTCC, right? That together with the investment on tokenizing treasuries on Canton, and making all the securities digitally eligible for custody, right? What does that mean? And also the JP Morgan coin project. What does that mean when those partnerships come together? For how you see the growth in the ecosystem, how what those institutions are looking for to set priorities and ultimately make decisions to get into those projects and get them through the finish line.
I mean, ultimately for their customers, it means 24/7 access to those assets and composability of those assets. Opens up all sorts of opportunities for off-hours financing, repo, spot markets, et cetera, et cetera, et cetera. So the whole collateral mobility project that people have worked on for decades is now finally technologically capable. And the excitement from these market participants is quite palpable. So we'll start to see a lot of these intraday, off hours, over weekend, cross corridor collateral ecosystems expand rapidly.
Yep. And Brina, on the stack side, you guys have integrated with BitGo, Hextrust, Copper for the custody. How critical of a piece is that to get institutions into Bitcoin DeFi?
I mean, you have to meet institutions where they are, like, full stop. So whatever their stack is, like, if your chain is not able to integrate that, you're never going to get the capital flowing for inflows whatsoever. We work with pretty much every custodian. Today we announced Fireblocks as well for the DeFi multi-sig as well, given there will never be a single site approver from any institution, or that would be extremely risky to be doing that. So I'd say that we work with a variety of custodians and kind of bespoke models that kind of serve. But I think even adding a layer of, can we build vault products with our custodians, or can we actually build products that already fit their regulated compliance so that we can meet institutions where we are. The other side of it is where it came in Foundation. We are exploring getting our own VEST license and offering structured financial products. We have a desire to build a collar swap on chain using SBDC or other Bitcoin derivatives, even from CB or W. But to offer those products, you need to be a regulated institution. And so we might be one of the few foundations going in that route.
Yep. And Juanita, would love to hear from you on more strategic partnerships and what institutional validation you've seen. And you have a very strong investor base as well. It includes the Paradigms, Coinbase, Circle. What beyond the capital part, what matters the most when you're building institutional relationship, and how do you leverage your investor base for this?
Yeah. At the end of the day, right, financial institutions want to know that we can understand what they're solving for and help bridge that distance between finance and blockchain. What matters most in these relationships is, how do we translate blockchain capabilities into financial outcomes? Institutions want to unlock T+0 settlement. They want to have 40 to 60% cost reduction and 24/7 market access. Can we do that? Can we help them do that with blockchain? Is that one of the tools that they can use to help achieve some of these outcomes? And so really, from a Monet Foundation, we frame Monet, the blockchain, in terms of a potential technology that they can use. And in helping them do that, in the path of getting to do that, it's understanding that actual pain point, right? And institutions aren't looking for innovation for innovation's sake, and they're solving for capital efficiency, they're solving for regulatory compliance and operational risk and client demand. So it's whether or not there's infrastructure addressing that. There's sort of people building alongside that help bridge that. And so again, they have decades of financial expertise, but very limited blockchain fluency. We have deep blockchain infrastructure knowledge, but also equally deep financial market experience from our founders, from team members even coming from the finance industry. And I think that combination is quite rare within crypto, within blockchain. And that's what's been able to help us build a lot of that relationship with the institutions. And a lot of our investor base help bridge that as well, coming from, in terms of that network, in terms of something they know how.
Yeah, and trying to wrap up the conversation, because we're actually about on time. Maybe two things for all of you is, on the one hand is, what do those institutions generally consistently underestimate when they go about entering the tokenized markets? And then we'll touch on the, what's coming up 2026 and what we'll looking ahead, what is coming up. But would love to get your point first on what they typically underestimate in friction points.
I'm happy to jump in here. I think that institutions focus very heavily initially, right, on the primary issuance of this, and sometimes overlook how to unlock the utility and distribution post-launch. tokenizing an asset, it's really just a starting point, right? The real value comes from making the asset useful and liquid. And so a really key piece of this is enabling composability with the DeFi protocols for lending, collateralization. That's really critical. And so I think what I've noticed and that institutions really appreciate our take care at the Mana Foundation is that we think that tokenization is in the finish line, right? It's functioning markets around it that is really critical, and we help that bridging as well in terms of sort of that knowledge base.
Yeah, I completely agree. I mean, it's one thing to put something on chain; it's another to make sure that you've increased its utility. And that can come in so many different forms. It can mean that it's tradable in certain ecosystems. It can mean it's pledgeable as collateral. It can mean you can create or redeem it 24/7. It really depends on what that asset class is. But my general skeptical question I like to ask people is like, what is the incremental utility that this produces by being on chain, and try to force that conversation as early as possible. Again, it doesn't have to be earth shattering. It doesn't have to be like a complete transformation of the way that it works. But you do need to be conscious about what is that incremental utility and who's your audience for it. Because also, if your audience is not someone who's on chain or has access to on-chain ecosystems, then maybe that innovation isn't going to meet the market. So you need to think about that as well. And my general advice to anyone is to just do something. Keep it as simple, stupid, tight as possible. Because I think the real strength, and I think I mentioned at the jump, like JP Morgan, is that they have almost a decade, maybe more than a decade, of institutional knowledge and know-how and people, and legal team that understands how to think about this stuff, and a financing team that knows how to report these things and track these things and hold these things. And that sort of institutional know-how gets built around the need to deliver something. And so it's important to get started somewhere and not to overthink what that use case is. Be able to answer what is the value of this and who is it for and are those entities available. But try to pick something really, really tight and straightforward, and then start to build that institutional knowledge, and then you'll be able to iterate off that firm base going forward as this ecosystem evolves and grows rapidly around you.
I think when institutions are kind of evaluating tokenization, crypto, DeFi as a whole, they always approach it as a technology problem from the get-go. How does this interrupt work? What exposure risk am I taking on with smart contracts? But as they get deeper into the integration or a partnership or actually deploying capital, what it ultimately comes down to is they're underestimating how they're assessing risk. No two blockchains are the same, no two markets are the same, but even more so than that, there isn't a streamlined way of how you're going to do risk monitoring across different chains and the alert systems that you're going to set up, which you always have in traditional finance, given same terminal that you're trading on. And so I do feel that institutions have massively overlooked that. And as they are then exploring going cross-chain, it becomes a friction point. At the end of the day, our goal as any blockchain service provider is how are we reducing the trust assumptions, because that is what institutions need. And it may come off to a trade-off for some of us where the trust assumption might actually be centralization, but goes against kind of the decentralized ethos of having validators, because in our eyes, we think, I think this is what Juanito was saying, that it's baked and set and we're ready to go. But in their eyes, alarm bells are going off. So kind of the underestimation of how risk and capital efficiency and what trade-offs you're taking is primarily what I'm seeing.
Mm-hmm. Very interesting. And okay, final round. So looking at 2026. Well, first, where can people find you, learn more about your project? Obviously, I think that's pretty easy with the Google search, but if there's anything you want to mention there. And then what milestones or capabilities should people be looking for in 2026? And Rena, if you want to, you're still muted. If you want to get us started.
Yep. Yeah, ours are pretty simple. We're stacks.co pretty much for all social handles. Very easy to find us. I'll keep this short and sweet. Our single milestone or KPI is we want to see 100,000 Bitcoin staked. We want to see it staked and deployed across DeFi, full stop.
Great. Perfect. And then who wants to go next? Juanita or Eric?
Yeah.
Juanita, go for it.
We can be found at mana.xyz and on X, etc. I think that for 2026, look, I think, the past hour we've discussed that institutions coming in terms of tokenized assets and what that looks like. Ultimately, the take that we have is institutions won't adopt infrastructure that tokenizes assets but doesn't unlock any additional value. And I think Eric mentioned that as well, without giving them any sort of utility. In 2026, what our focus is going to be on demonstrating that tokenized assets that are launched on Monet can gain utility, liquidity, and demand, making us a chain of choice for a lot of these institutions.
And last but not least, Eric.
Yeah, I mean, we generally, we talk about the TVL metrics because obviously it's just kind of a way to talk about that the ecosystem is, being adopted and that it's eligible for institutional activity, but it's not a KPI for us at all. I think that that's been a miss for most ecosystems to be talking about TVL as a goal instead of just kind of just an interesting indicator of willingness to participate. For us, our most important metrics are around burn in the network. So how active is the chain at any given time? Transactions burn all of their fees, and that's directly accretive to any token holder in the ecosystem. And it's a really strong indication of utility. So someone that just moves a treasury on chain, it sits there, doesn't generate any burn. Treasury that gets pledged as collateral and repledged and used in repo and rehypothecated and all that generates burn. That activity is important. So velocity of assets as measured ultimately in burn in the network is the most important KPI for us as an ecosystem. And we anticipate that to grow steadily over the course of this year as more and more assets come online and their increased utility is expressed through institutional financial workflows.
Very clear. Very clear. So here we are. I think that wraps it for today. Thanks again to all of you for joining us today. Thanks to everyone who's been watching live and who will be watching the replays. And that's it. See you at the next one.
Thank you very much.
Thank you.
Appreciate it.